end of the webinar, you will get to know like why you should be bullish on India, and why you should basically invest in India. So let me start with my presentation. So as I told you, just if you have any doubts, you can let us know. Let me know on the chat, and I would request Arjun and other team members to just let me know if anyone faces any doubt. So we will be covering three presentations which I have made for you. So my voice is audible, right? You can just write down yes on the chat functionality. Hello. Yeah. Is my voice and my screen is also visible? Just write yes. Yeah. Perfect. 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 So, so Warren Buffett, he is one of the greatest mind in investing. So he also started his journey. So he started his journey. He was not that rich, but as one says that if you are born poor, but if you do not make it big, then it is your fault. So he started investing in the age of 11, and what thing happened was in the interview, one media person told that what is your biggest regret of your life? You are the most richest person. You have all the dollars, billions of dollars. So what is your biggest regret? So he told this line: I started investing when I was 11. I was 11. I thought that 11 years was too late. Basically he meant that कि मैंने 11 years में अपना investing start किया था, and I think कि what I was doing till the age of 11, why I didn't start it earlier. So we will get to know कि why he said this. And there is one quote which I would like everyone to write, is that if you don't find a way to make money while you sleep, you will work until you die. So it is very important to invest. That is why the power of compounding in the early age would maximize. So this is the power of compounding. So I hope everyone is clear with the concept of simple interest versus compound interest. Just mention on the chat, please. Perfect. 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 So on the simple interest and compound interest, just to give you through two slides, compound interest is basically uh, compounding of your money. That is ब्याज पे ब्याज मिलना. So for example, in simple interest on 1 year, if you invest $100 and get 10%, so on first year it is 110, on second year is 120. That is only $10 got added every year, only 10. Whereas in this 110, then 10% of 110, that is 121, 121 plus 10% of 121, that is $133. So we will be doing a very interesting exercise today. So I have made this thing to explain you better in simple interest and compound interest. So just let me know. Let me just make it. Yeah. Anyone who wants to do this experiment, just tell me your age in the chat box. I will tell you like what amount it can happen for you guys. 13. Perfect. So I will take Ritik as an example. Just understand the power of compounding. It is phenomenal concept. And we assume your age of retirement at 60 years, which is decent in India. Everyone retires at 60, although we can reduce it if you want. For example, Ritik wants to enjoy his life. He only wants to work till 55. So let me do 55. So what we have done is we have taken Ritik as an example. His current age is 13. His age of retirement is 55. So years of investing is 55 minus 13, right? 42 years he can invest. Are you all with me? Perfect. So that is months what we mean by months is how many months. We know the year of investing is 42. He can invest for 42 years. Just let us see how many months are there in 42. So what we will do is we will multiply 42 years into 12. That is 42. He will be investing 504. So Ritik, how much amount you can save per month? Just give me a rough idea. 5,000. Perfect. Your amount would, and interest rate we have assumed it is amount per month he can invest 5,000. So total amount he would be investing is, total amount he would be investing is 5,000 into the months that is left. So total amount would be around 25 lakhs. Okay, that is the total amount he has invested. Let me color it. Yeah. So interest rate we have assumed is 15%, and the reason between 15% we are assuming because the India grows at 15%. Now the question comes, you would be saying, sir, how you can say 15%, because in news we read that the GDP, that is the gross domestic product, increases only by 6 to 7% in India. Whereas the GDP formula is nominal GDP plus inflation rate is equals to, sorry, real GDP plus inflation rate is equals to nominal GDP. So what we have assumed is 7% India grows. Along with that, inflation also grows at 5 to 6%. So that is how we have come at 12%, and 3% is more because obviously the more risk you take, the more return you get. So that is 15%. So let me tell you how to put this formula. So it is very interesting activity you all guys should do. I would be sharing this Excel with you, everyone. So this is the formula. What future value is? Future value is basically if Ritik gets invest 5,000 rupees per month and gets 15% interest. So what will amount will be at the age of 55? So what will we do is equals to future value bracket 15% rate divide by 12. Now the question comes, why you have put 12? Because he is investing per month. That is why divide by 12, because he won't be getting 12% and 15% every month. It would be 15% divided by 12. Number of periods is 504 because he would be investing 504 months. Payment amount minus 5,000 rupees. Why minus? Because it is getting subtracted, right? If I get the money, it is positive for me. If I am investing, it is negative to me. That is the negative cash flow. Basically, you are investing. That is why a negative sign has been put. Okay. Present value means how much amount you have. So let us assume he has nothing, zero. Okay. He can save 5,000 per month, and he wants to enjoy his life. He wants to do other activities. So he does not want to invest more. So one. So this is the amount he would be getting at his retirement. So that is 21 CR. Everyone understood this calculation? Please. Perfect. Anyone has doubt, please, please let me know on the chat, because it is very important exercise for you all. Perfect, no doubts. Perfect. So I would request everyone to do this exercise with you guys. Just let me repeat it once. Should we find the CAGR also in this? So CAGR is 15% only, because this is the CAGR that we have assumed. 15%, which is nominal, because if you invest in, we will be covering where you can invest to get 15% in the long run. So you will get to know why the 15% has been taken into consideration. Let me repeat it. So the case study was Ritik, his current age is 13 years. We have assumed he wants to invest till only 55 years. His age of retirement is 55. So years of investing, what we simply did was 55 minus 13. That is how we got 52. Then how many months he has. So it is also basic thing. So what we did was 42 into 12. That is equals to 504 months. So per month, he says he can invest 5,000 rupees and interest rate is 15%. So total amount he would be investing is 25 lakh. How we got this is 5,000 into number of months, right? And this is the future value. So let me also show you the power of compounding. So for example, Ritik wants to extend his age, or he do some conjugacy and save 1,000 rupees again. So let us assume he saves 6,000 rupees. So what we will do is, let me find it, future value, 15% divided by 12. Number of periods remain the same, 504 into payment amount, that is minus 6,000. Why we got minus? Because it is negative, because we are investing, right? Future value, let us assume 0. He do not want to invest any lump sum amount. Just see, the gap was 25 cr. There was a, just because of 1,000 rupees, there was a gap of 4 cr, right? So that is the power of compounding. That is why I started the presentation with the biggest regret of Warren Buffett. So that is why he says, why I didn't invested at the age of, why I started investing at only the age of 11, why I didn't start before. That is why his biggest regret is that. So everyone, the concept is clear. Let us proceed further. Perfect. Perfect. So this is how the Warren Buffett, if you can see, he started. So the power of compounding is back-ended. So for example, the most amount of compounding would happen in the last years, because everything that's get doubled. So for example, at the age of 52, till the age of 52, he was not a billionaire. But once he became a billionaire, then the power of compounding started. 1, 2, 4, 8, 11, 15, 36, 62, 84. This is how it got started. That is, he says that the power of compounding is so much. It is the eighth wonder of the world. That is why he says. So let me get back to the basics. So we first understood the power of compounding. Then we did the Excel sheet, where I would encourage everyone to just go through this Excel sheet and do activities on that. And then there is Benjamin Graham, which is the father of value investing. He says if you are buying a stock, then you are buying a piece of a business. So what he means is, in market, everyone do the trading and all, but like there is a stock, there is a business behind it. So for example, can you tell me, anyone, what things you use? Let's find out. So if you, for example, there is Burger King, for example, Zomato. Everyone is aware of Zomato. So there's a company behind it. There is a business behind it. For example, Asian Paints, there is a company behind it. So what he means to say is, if you are buying a stock of Asian Paints, it means you are buying a piece of the business of Asian Paints. You will be participating in the growth of Asian Paints. Your return, yeah, my voice is lagging. Uh, my voice is good. Should I continue? Okay. Okay, perfect. There is a question on the chat, is the current rate of interest at 8% per annum. Yeah, you are right. So the current interest is 8% per annum only in FD, fixed deposit, not in stock market. So for example, if you take higher risk, then obviously you will get, what I told you was, you can assume 15%. or 12 to 13% in stock market. Why? Because India grows at 6 to 7%. That is the real GDP. Plus we add inflation. Inflation is 4 to 5%. Every quarterly or 6 months, RBI comes out with the inflation data. So you can add that and can assume the rate. Perfect. So I told you, like, behind every stock there is a business. So for example, if you are eating Burger King, if you are eating a burger of McDonald's, Burger King, so there is a business behind it. If I own that stock, then I would be benefit from it. So you can list down 5 to 10 or 15 to 20 companies. Like how I started my journey was, what I used to do is, before consuming anything, or I used to see around myself. For example, there is a paint. For example, a fan is being run, so it is Havells. So I used to look into the business opportunities like this in my early stage. Then I used to read the annual reports. Then I used to read the con call reports to understand how the business is being run. So this is the returns of different asset classes over a period of time. So in India, if you see, there are 4 to 5 asset classes where you can invest. So for example, there is fixed deposit. So fixed deposit, everyone knows, it is an FD, in which 60 to 70% of Indians invest because they assume it as a safe instrument. I'm not against the FD, but what you guys have to understand is, there is a concept known as inflation. Just ask your mother, father, that every year how much percentage of expense gets increased. For example, in the month of March, uh, in 2022, if my household expenses is around 40,000 rupees or 20,000 rupees, then after a year, in the month of March, it won't be same. It would have increased. You also must have seen, earlier Mekalu Tikki burger was just 25 rupees. Now I think it is around 40 to 47 rupees. So this is the inflation, the concept of inflation. So there is a quote by Buffett also. So for example, at the current year, if a burger costs rupees 100 and I have 100 rupees, I can purchase one burger. But what you did was, you invested that money, and after 2 years, the money is, let us assume, it got 115. So you got 15 rupees as a interest, but the same burger costed 115 now. So the real purchasing power of yours didn't increase. That is why investing is important, to increase your earning capacity, right? So fixed deposit, we get 5%. This 5% we have assumed because if you see top banks like SDFC, SBI, ICCI, they offer FD of 5 to 6% interest rate. In commercial real estate, you get 7%. Residential real estate, it is very bad at Delhi. It is just 2%. So for example, if my house uh, is of 1 CR, I would be getting a rental yield of only 2%. That is only 2 lakh rupees per year. So stock market, you can assume 12 to 14%. If you invest in good mutual funds, that I would be telling you how you can invest that in. Now, it is very important slide. If you just have a look on this slide, let me tell you. So what we have assumed is, the stock market started from 1981. The Sensex, we have a history of around 42 years now. So it is the report that is being published by Value Research. It is one of the portal where you can get all the validated information on the returns of the mutual funds and everything. That is probability of losing money over the long run. What they have did was, if you have invested, for example, why we say that in equity markets you have to invest for a long time period. So the probability of loss they have assumed, they have calculated back. So if you, for example, if you invested 100 rupees only for 1 year and took the money back, then your loss of probability is 26%. You faced a loss. Whereas if you invested the money for 3 years, then your probability of loss is 14%. So it means 86% times 86% you gained. Then if you invested 100 rupees for 5 years in equity market, the probability of losing is only 11%. Whereas if you extend it beyond 10 to 15 years, the probability of losing is zero, zero. So that is why we assume the age of retirement. And I would encourage everyone to invest in equity for the long term, not for 1 to 2 years. So we have different funds, different products. If you have a time horizon of 1 to 2 year, so the major learning, if you want to take one major learning, is start your SIP at this age, at 13 14 years of age. If you compound your money till the age of 55 60, you have seen what magic it can happen. Now there is a chat. How does no? So Ashutosh, I got your question. So we will be addressing this question in the third slide. So it is covered. So I will tell you like what is active, what is passive investing. So in this you will get to know like do you have to invest in a single stock, or how it goes. So I won't encourage Abhi to invest in a single stock. So we will deal with that. We will come in. So you guys must have seen that Indians love gold. So we have also bring down the chart, that is return of Sensex, that is equity, versus the return of gold. So you can see the Sensex return versus the gold return. So it means that obviously in the long run, business will give you much higher return, because everyone do business just because to get a higher return, right? So in business, if you survive, you will get a higher return as compared to other asset classes in the long run. So now we come to the concept of now I have told you, let's get back to what is compounding, why you should invest long term, because the probability of losing is less. Now the question comes, where, sir, where we have to invest, right? So let us from this slide we will get to know like where you should be investing. So we will be covering a concept known as mutual fund. So you all must have saw the ad of mutual fund or some knowledge. You must be. Have you heard the word mutual fund? Just comment me. Yeah. Yes. So there is a famous ad. ये सही है, mutual fund सही है, right? So what is mutual fund? Let us understand this from the basic, and then we will advance to the active and passive. What is mutual fund? So what is mutual fund is, what they do is, for example, there are 10 to 20 people. There is a pool of people who wants to invest but does not have the time or the knowledge to invest. So what mutual fund gives is, they will collect for example 500 from each and every one. They will pool that money and will give it to a professional fund manager whose day and night job is to just research, invest your money. He is more equipped with the knowledge of equity. So that is a mutual fund, that is a concept. So for example, this same concept applies in the insurance as well. So what happens is, in insurance, insurance company takes premium from 100, and if anyone faces any major crisis, they give out to 1 to 2 people, right? They give out to 5 to 10 people. So they pool the money, they invest, and from that investment, if any claim arises, they settle it out down, right? So but in mutual fund, what happens is, they collect money from 5 to 10, 15, 20, 100 of investors. They make a pool, and then it is being given to a fund manager who invest your money on your behalf. So in mutual fund, there are three types of mutual fund. There are different caps: small cap, mid cap, and large cap. So what it means be with the small cap, mid cap, and large cap. So large cap obviously means large company which has large market capitalization. In large cap, for example, Reliance Industries, Tata, TCS, Tata Consultancy Company. Then you have all the examples of large cap: Asian Paints, Divi's Laboratories. So mid cap is, which is less than the large cap. Small cap is major. Small cap is the growing companies who has some niche, who has a who is in the middle of becoming a mid cap. So that is how alpha gets generated. So if you invest in a small cap and it becomes a large cap or a mid cap company, then obviously you will be earning high. So as the mutual fund concept is being known with everyone and they are doing a lot of ads, there is a everyone is shifting towards mutual fund. So if you see everyone is investing, just see the growth rate of investment in mutual fund, that is 20% CAGR. So everyone is investing in mutual fund. So that is why it is important to understand what is mutual fund, what are the different caps of mutual fund. Obviously, large cap will have less risk, mid cap will have a little bit more risk as compared to the large cap, and small cap will have a major risk. So in India, there are, as per SEBI, which is the regulatory authority, they have divided all the caps into these. So let us understand. I have already told large cap, I have already told mid cap. There is a mixture of large and mid cap. So for example, a fund manager wants to invest in both the companies. They want to select 15 stocks of large cap and 10 stocks of mid cap. So there is a special mutual fund for that. There is a mutual fund only for the small cap fund. Flexi cap means that you can invest as per your convenience. So it basically means if a fund manager wants to invest 5% in small cap, 10% in large cap, only 50% in mid cap, so he has no foundation. Even international funds, in flexi cap, he can invest in international. So can you name 2 to 3 companies, international companies? For example, Google, Apple. If you want to own that business, you have to go with flexi cap, who has a mandate to invest in international funding. This is known as flexi cap in international funds. In international funds only, the manager would invest only in international stocks. Let us understand what is the difference between sectoral and thematic. It is just the slide is almost about to get ended. You will get the full knowledge of mutual fund. Sectoral means a basket of a particular sector. For example, there is a pharma sector, there is an IT sector, there is a manufacturing sector. That is a sectoral fund. So if you invest in, for example, if you invest in pharma, so you will be owning Lupin, DVs, all the pharma companies. Whereas thematic fund is in a particular sector, a particular theme. For example, in automobiles is a sector, whereas thematic is automobiles plus EV. EV is a thematic. So what will happen is a mutual fund manager would, if you offer a sectoral fund automobile, so he will be investing in Hero Motocorp and all these companies, Maruti Suzuki. Whereas thematic is he will be focusing on a particular theme, that is EV. So companies which is into the electric vehicles, they would be investing. For example, Tata Power, who is investing into the next future. That is a thematic fund. ELSS is basically where you get deduction under the Act of ATC. So it is not complex. What happens is once you file income tax return, you can get a deduction. ELSS. That is a simple. So now let me tell you, there was a question like where to invest. So you got the knowledge of mutual fund. Now there is two type of funds. You got the understanding of the different caps that is involved in the mutual fund. That is active investing. Then there is a fund known as passive investing, which is Nifty, which is you invest in the basket. That is top 50 companies of India. So Sensex is top 30 companies of India, top 30 companies of India. So what happens is in this active investing where the fund manager is involved, where he is involved, he will obviously be charging something, right? 1 to 2%. So John Bogle is one of the greatest mind. He says that when returns are concerned, time is your friend. when returns are concerned, time is your friend. That is why it is important key. I told you the power of compounding. So the more the time, the more the benefit. So the average age of this group is 13 to 14. So that is very good that you are understanding these concepts at this age. So make time your friend. In start investing, save little bit money, 500,000 rupees. That is all. Like for example, if you can't invest 6,000, just invest 500. So then also you will get a good amount. That is 15%. Obviously, you can increase later on once you uh, start earning. Once you, it is 2 CR, and the total amount invested would be 500 into 504, just 2 lakh, 2 lakh 52,000, right? So that is the power of compounding. With the just a corpus of 500 rupees, you would be getting around 2 CR. That is the power of compounding. So let me get back to his question. So his quote is, when returns are concerned, time is your friend. But where costs are concerned, time is your enemy. Let us understand this. So as I told you, there are two type of funds, where is active and passive. In active, there are a lot of thematic funds, sectoral funds, different cap funds, large cap, mid cap, small cap, international funds. But in passive fund, there is Nifty 500, Nifty 50, Sensex 30, where we are saying fund managers, please do not use your brain. Just invest in top best 50 companies of India. Just invest in top 30 best companies of India. There is a question, is a mutual fund with a low NAV better? No, no. There is a misconception in India is that, for example, if a stock is trading at 2 rupees and if one stock is trading at 2,000 rupees, uh, uh, people try like to invest in 2 rupees stock. They think it is inexpensive. No, it can be a bad company. Secondly, everything depends upon the market cap. So what is market cap? For example, there is a whole pizza, and if you divide it into 5 pieces, that is the market cap of each and every. If you bulk it, then a pizza comes. That is a market cap, right? So there is a misconception that low NAV is better. Okay. Yeah. So where the costs are concerned, time is your enemy. So what he means is he is a believer of passive investing. So what he means to say is, you can avoid 2% giving it to a fund manager, and you still invest in passive funds where there is no the expense ratio is less. So, for example, in active investing, there is an expense ratio of around 1 to 2%. In passive investing, only 0.10, 0.20 expense. So you save around 1 to 1.4% of interest, right? So let us understand some pros of mutual fund. The best pro, that is the advantage of mutual fund, is a professionally fund manager, because obviously you have your school, you have your job, you have various things to do. You cannot focus on one thing. So you give that expertise, that money of yours, hard earned money, to a fund manager. So he invests with all the knowledge he has, right? That the cons are high fees as compared to index investing, that is a passive investing. So let us understand what is active investing once again and passive investing. Active investing is a fund manager chooses the stocks actively. Basically, he chooses his stocks. Expense ratios are higher due to high expenses, obviously, because more effort is taken into consideration. There is the fees of the fund manager, so expense ratio would be high. Whereas passive investing is dumb money ceases to be dumb when it accepts its limitation, means buying the market. Passive investing is simply buying the 50 best companies of India, best 30 companies of India. So there is low expense ratio. Okay. So this is a study given by Value Research. So if you see in the long run, what has been observed is most of the mutual funds, that is the active mutual funds, have underperformed, have not beaten the index. So if you see, this is the returns outperformed by the index. If in the long run, for example, 10 years, only 65% of the active mutual funds outperform index. So it means you can see that 35% outperformed. Index fund outperform the active 35%, 48, 40, 86, 100. And last, what I want to show is, what he says is, index funds eliminate the risk of individual stocks, market sectors, and manager selection. Only market risk remains. It is being said by John Bogle that go with the index investing. Even Warren Buffett, what he has done is, uh, once in his will, he has written that once I die, just invest all my amount into the index investing, because whatever happens, if the 50 companies do not perform, then the bad company goes out automatically and a new company goes into the index. That is index investing. So my recommendation would be to start early investing, then go with the index fund. Invest in Nifty 50, Sensex 30. Yeah. So now let's open the Q&A round. You can ask any question, and I would be happy to answer it. Please. So one question I can see is, what are the tax benefits in mutual fund? So the tax benefit in mutual fund is, if you invest in ELSS, you would be saving 1.5 lakh. Yeah, please ask your questions. Hello. Hello. Yeah, please ask your questions. If you want to use the chat functionality, you can, or you can just unmute yourself and ask question directly. So which is the best platform to invest in stock market? So Ashutosh, you like what we do is, we use traditional brokers only. So there are traditional as well as I would say new age companies, for example Zerodha, Indeed Money, or Grow. So we prefer to invest through ICCI or SDFC, because they have a track record. They have a track record. But I am not saying that these new brokers are not good. They are also pretty good. So you can start with Zerodha or Grow, which has some credibility, which has the credibility. Yeah. Equity versus real estate, which one is better? That is a very interesting question. So in India, everyone loves real estate. Everyone loves real estate because in real estate, uh, there are tax benefits. There, what we have seen in earlier is there is a huge appreciation in the capital, in the prices of the real estate. But as I showed you the graph uh, of equity versus real estate, in real estate, the long term return, the long term, I mean to say 10 to 15 years, 20 years, is just 7 to 8%. That is the average return what you have got. In equity, the average return that you have got is 12 to 13%. Along with, you get extra dividend as well. So 12 to 13% is the capital appreciation, plus if you take into consideration 1 to 2% as a dividend, so the total is 14 to 15%. Could you explain caps again, sir? Sure, sure, sure. Let me show. So, so this is being question being asked by Manasvi. So Manasvi, you are like you got the concept of mutual fund. Perfect. Perfect. So Manasvi, so let me tell you about the different caps involved in mutual fund. So, in if a fund manager has a mandate of investing only in the large cap, so large cap are those companies with this 1 to 100 company in terms of full market cap. Basically, 100 companies of India which has the highest market cap. For example, Reliance Industries, Tata Steel, for example, Asian Paints, for example, Bajaj Finance, for example, SDFC Bank, which is the top 100 companies of India, uh, which is listed. This is the large cap. Mid cap is fund manager has a mandate to invest uh, in 100 to 250th company. Basically, he cannot invest in 1 to 100 companies, which is top. He would be investing in 101 to 250. That is the top 150 companies जो 100 से ऊपर हैं उनमें वो invest करेंगे. And small cap is 251 onward. Okay. So is your doubt clear? Perfect. So let me explain again. Large cap is top best 100 companies of India, which is listed. Mid cap is 101 to 250 top companies, and small cap is way beyond 250. Harshit, real estate is viewed as a sure and secure investment option. So Harshit, there is a concept known as PE ratio. What PE ratio is? It is simple. Let me show you. What is PE ratio? P ratio is simple. You can calculate in each and every aspect. It is price divided by earnings. So, for example, if you want to study abroad, right? So the cost of studying abroad is, for example, it is 1 lakh rupees. Just for example, and what earning you think that you can derive is, for example, 10,000 rupees. So your price to earning ratio would be 10, or let it keep 20,000, and price to earning ratio would be 5. So you would be getting, you would be uh, जो आपने amount invest किया, that is the price that you have put in 1 lakh, you would be recovering it in 5 years. So earlier the real estate was, yes, was a good investment asset class, but now as the prices have increased so much in Bangalore, in Delhi, just calculate the P ratio. So what is P is price to earnings ratio. So how much years you will get your capital back. So if it is beyond, for example, in Delhi, it is 1 CR property, just give you around 20,000 rupees a rent per month. That is around 2 lakh 40. So their P ratio would be 2 lakh 40,000. So we will divide that and we will get the ratio. Price divided by earning. It is 41. Just imagine, you will be getting your capital back in 41 years. So what you would like, what better thing you can do is invest in yourself. In the first example, go to study abroad, get more earnings, because you would be getting your capital soon, because capital is infinite, is not infinite, sorry, it is a finite thing. So Shahid has a question: what are the indicators of risk in a mutual fund scheme? Right. So what checklist you should see in mutual fund is who the fund manager is, what is his track record. Second, what is his mandate? So is he investing in large cap, mid cap, small cap, right? Fourth is what is the turnover ratio बोलते हैं उसको. कि basically what happens is uh, does he invest money for the long run? Does he invest in good equity companies? So पोर्टफोलियो चर्न रेट पता लगता है, दैट इज अ टर्नओवर रेट, कि बेसिकली आपने 10 स्टॉक्स में इन्वेस्ट किया एंड इफ यू होल्ड इट फॉर 1 ईयर देन टर्नओवर रेशियो इज 0%, बिकॉज आपने उसमें से कुछ सेल नहीं किया. बट इफ योर टर्नओवर रेशियो इज 100%, फॉर एग्जांपल 10 स्टॉक्स लिए और 1 साल में ही बेच दिए उसे, या आप चेंजेस बहुत करते हो, then that is a turnover ratio. So you should see which fund has a less turnover ratio, or go with the passive fund. Because in passive fund, what happens is automatic hota hai. If the company does not perform, it will be getting replaced with the company that performs. Any other question? So what all should we check all about a company to invest in stock market? Ashutosh, what it is a very wide concept. So in SOIC, we try to explain that like what factors to look in a company, how to value it, how to build a portfolio. So if you are interested in picking stocks, because in active investing the return is humongous. So if you must have heard the stories like I invested in SDFC Bank, ICCI Bank, Axis Bank, Asian Paints, Royal Enfield, Eicher Motors, Relaxo. So if you have invested in these beautiful companies, your rate of return would be around 20-25%, right? So you should first invest through passive, then little bit go into the active, and then if you want to do stock investing, then go with the learning first, and then build your own portfolio. So this is what is being taught in SOIC. So which is better, buying single stock or multiple stock, right? So so there is a very good saying that never put all your eggs in one basket, right? Because what happens is, if you invest in only in one stock, right, and if anything goes wrong, and you there is two rules in investing. First rule by Warren Buffett is never lose your capital. Never lose your capital. Second rule is never forget rule number one. Why he says that? Because if you, for example, if you invested 100 rupees and anything bad happened, for example, company defaulted, or there was a corporate fraud, or you overestimated the earnings. So for example, the company went to 70. So can you tell me like how much return you need to get back your capital? Harshit? So in order to get back your capital, that is 100 rupees आपने invest किया on the it the business had any flaws or anything, and it goes to 70 rupees. So what happened? In order to get back your capital, you need not 30% return. You need, just to get your capital, you need 35% return, right? आपको 70 rupees को 100 करना है, right? नॉट 100 को 70, 70 से 100 पे जाना है, तो यू नीड हायर रिटर्न. सो दैट इज व्हाई इट सेज दैट अब नेगेटिव मत होना, दैट इज सर्वाइवल. एक कोट है, सर्वाइवल इज द ओनली रोड टू रिचेस. So that is why it is. So you got my answer, Harshit? Yeah. Uh, no. So let me tell you again. There is a quote: survival is only road to riches. And there are two rules of Mr. Buffett, that is, never lose your capital, rule number one, and rule number two is don't forget rule number one. He says it because if 100 rupees goes to 70 rupees, to in order to get your capital back, 70 ko 100 karne mein you need 35%. You don't need 30%. The more return you have to generate, because 70 ka aapko 100 karna hai. So what our recommendation would be to have a 15 to 20 good stocks. in your portfolio. But before stocks, I am again repeating, go with the passive investing first. Buy the index, for example, Sensex 30 or Nifty 50. Then you can look into the active. Then you can study a lot, and then you can pick your own. Right? Any other question? What is the best approach to analyze mutual fund? I will share the checklist that we have made while analyzing the mutual fund. So let me repeat 4 to 5. That is the track record of the fund manager, the association of the fund manager with the fund. So track record 35 years हो, but वो mutual इस fund में उसको खाली 1 साल हुआ हो, right? You do not want to associate it with that. Third is less expense ratio. As I told you, the more the expense, the lesser returns you will be getting, or the chances of getting high return reduces. Fourth is turnover ratio. कि ये ना हो कि the fund manager buys and sells a lot of stocks. Screener website is very good tool. So they have revolutionized the research part, so you can get each and every track record, profit and loss, sales of 10 years, 5 years. You can put filters as well. So it depends upon how you use Screener website. What are your filters? What are your filters? For example, you have a filter of key, I want a company whose there is a sales growth of 15%, ROC, that is return on capital is 15%, कि वो profit कितना percent कमा के देती है. Sales growth, ROC is 15%, then you will get a list of stocks. Then you can do more research on those companies. So Screener is a good platform for it. And there is annual reports also available on these Screener. So you can read what company says, what is its future plans, who is the management is, what is the track record of the management, is the management competent or not, who has invested in these companies, right? Any other question? Perfect, perfect. So Arjun, if you have any other question, you can also let me know.
Hello, sir. Are the questions exhausted now? The children have asked so many of them. So no, sir, we do not have any questions right now for you. Are you able to hear me? Are you able to hear me?
Yes. Now.
Okay. Yeah. So yeah, sir. So we can come to an end over here. Thank you so much, Sarthak, sir.
Thank you. Just to conclude, 5 learnings from this is, first is, do not forget the power of compounding. I would encourage everyone to calculate the future value. Just make 2 to 3 goals. For example, you can invest 500, 600. Then thirdly, we understood the concept of mutual fund and what is the difference between active and passive. First, you should go with the passive, and we understand what is the expense ratio. Fourth, the major thing that I want you to take is there are 2 rules of investing. Rule number 1, never forget, do not lose your capital, and rule number 2 is never forget rule number 1. Yeah. Now we can conclude.
Yeah. Okay, thank you so much. Yeah, thank you so much for encouraging students to invest. But just to be cautionate, please ask your parents and then invest.
Right.
Do not invest directly, then otherwise the whole blame would come on us.
Yeah,
Yeah.
do your research before investing. Take help with your parents. There are a lot of content is available now, so you can explore that. Even every Sunday we post a video on SOIC to our main aim is to provide more and more value and awareness among everyone how to invest. So you can explore that as well.
Yeah, so please do check out the SOIC channel and follow it, because it will just benefit you. We'll also share the SOIC YouTube channel link on the Discord server for all you guys. And also a big thank you for the whole SOIC team and you, sir, Sarthak sir. So the last session also was organized by Sarthak sir only. Like Sakit Malhotra sir was also invited by Sarthak sir. So thank you so much, sir. We
Thank
hope
you.
to connect with you soon again.
Sure. Thank you. Thank you.
Yeah, thank you so much, sir. We also have something for the students, right? The email thing. We'll also be sharing it with the students. So you'll have some activity and a little surprise thing type for these students. So we have planned something for them,
Right.
and we'll be sharing it very soon. Like sir will be sharing it very soon with you all.
Yeah.
Okay, thank you so much, sir.
Thank you. Thank you.
We'll again contact you in some time.
Thank you.
Yeah, and students, please stay for a while. Okay, so the recording can be stopped now.